Welcome to Option Series 2, Chapter 1. In this episode, we will look at the introduction to option spreads. And before we move to option spreads, we forgot to discuss one important topic as part of Series 1, which is India VIX.
India VIX.
Now,
India VIX is the volatility index that represents the fluctuation in the price movements of Nifty index for near term.
So we know in options there are stock option and index option, and every option has got call option premiums and put option premiums assigned for different strikes, right? So in this case,
Let's say if the value of India VIX increases, then both the call option premiums and put option premiums for Nifty index will also
increase, right?
And if the value of India VIX decreases,
Then both the call and put option premiums will also decrease. If you look at the value of the India VIX on the charts, so we have taken a monthly chart here.
the lowest value is 8.1 and the highest value is 86.5.
Now, what is the significance of this value? Lower the value,
Less volatility.
and higher the value,
Then
high volatility. We can split the range into different categories. If the India VIX value is between 8 and 12, then it is low volatility. If the value is between 13 and 18, medium volatility. If it is greater than 19, then it is high volatility. If you look at the monthly chart between 2010 and 2023, which is 13 years, we're talking about almost 156 months. For 56 months, the India VIX value was greater than 20. The rest of the months, it was less than 20, which means 35% of the time, India VIX was high, and 65% of the time, India VIX was low to moderate, which is less volatile market. For example, in the last 3 months, Nifty shot up by 3,000 points, right? From 19,000 to 22,000, right? Now, if you look at India VIX on the charts from November to January, India VIX also shot up from 8.2 to 16, which is almost 100%, right? So when the Nifty index moved from 19,000 to 22,000, India VIX also shot up from 8.2 to 16, right? And in this case, what happened is all the call premiums of Nifty option index was increasing, but the put premiums were flat till the date of expiry, right? Likewise, during COVID, what happened is when Nifty fell from 12,400 to 8,500, India VIX shot up from 20 to 86.5. And in this case, during the bearish market, the call option premiums were flat and put option premiums were increasing till expiry. Okay, this is how the India VIX dynamics works, and India VIX is a very important factor because it has a direct correlation to the option premium prices, and therefore it is very important for us to take India VIX into consideration while taking the option strategies as well as while maintaining the option strategies, which we will see in detail in the series 3 and series 4. Now let's look at the option spreads. Option spreads provides a trader with multiple option strategies that can be deployed based on the market view, right? And these option strategies provide both hedged and risk-defined models to minimize the overall risk exposure. So we have two different option spread models. One is hedged and risk defined, and the second one is hedged and risk undefined. Let's look at the first model, which is hedging with risk defined model, right? Now we have seen in the basics how the hedging works. So for every option sell, we need to buy an alternate option that will provide us with an unlimited profit, which is option buy, right? So hedging is an option sell plus an option buy will provide us an hedging. Now, when we combine hedging with risk defined model, this model will generate lower return on investment, which is a limited profit, and this model will generate a limited loss if in case the view goes wrong. Now this risk-defined model will have multiple positions with same expiry date and same quantity. We will discuss this in detail as we move on to individual spreads. Now with this hedging with risk-defined model, the cost of capital will be reduced by 1/5. As we saw in the series 1, if you sell one lot of Nifty, the approximate capital is around 1 lakh, right? But if in case you do an hedging where you sell 21,700 call option and then you hedge that with a buy, right? So you buy 21,800 call option, then the cost of capital reduces to 26,000, right? The last advantage is there is more emotional stability in terms of fear and greed because of limited profit or limited loss. The second model is hedging with risk undefined. The first model was hedging with risk defined. The second model is hedging with risk undefined, right? Hedging, we know for every option sell, we need to maintain an option buy, right? Now, in risk undefined model, option spreads will have multiple positions having same or different expiry and same or different quantity. In the first model, which is risk defined model, the multiple positions will have same expiry and same quantity, whereas in risk undefined model, the multiple positions within the option strategy will have same or different expiry in combination with a same or different quantity, which we will discuss in detail when we see individual option spreads. Now this model will generate higher return on investment with high profit percentage, but it exposes to high risk with unlimited loss in case the view goes wrong, right? So this model will also reduce the cost by 1/3, and with this model the emotional stability is always less because there is a probability of making unlimited loss if in case the view goes wrong, and if in case the view goes right, then you get a higher ROI. Okay. So coming to the final section, I have categorized the option spread models into 3 different subcategories based on the market view, right? The first one is if the market view is directional, which means if the market is either bullish or bearish, only the first model that we discussed will be applicable, which is hedge with risk defined model. And we have 2 different option spreads. One is a debit spread and one is a credit spread. The second scenario is if the market is in non-directional mode, which is in sideways mode, then both the option spread models will be applicable here. With the first model, which is edge and risk defined model, we have 2 option spreads, which is iron fly and iron condor. And in the same sideways market, the other model, which is hedge plus risk undefined model, will also be applicable, and we have 6 spreads here. One is short straddle, short strangle, ratio, diagonal, calendar, and butterfly spread. So we have 10 different option spreads which can be used by a trader to deploy their trades based on the market trend and based on the available option spread models. We will discuss each option spread in detail in the next episode. Thank you.